Welcome to the Judgment Call Podcast, a podcast where I bring together some of the most curious minds on the planet. Risk takers, adventurers, travelers, investors, entrepreneurs, and simply mind-bogglers. To find all episodes of this show, simply go to Spotify, iTunes, or YouTube, or go to our website, judgmentcallpodcast.com. If you like this show, please consider leaving a review on iTunes or subscribe to us on YouTube. This episode of the Judgment Call Podcast is sponsored by Mighty Travels Premium. Full disclosure, this is my business. What we do at Mighty Travels Premium is to find the airfare deals that you really want. Thousands of subscribers have saved up to 95% in their airfare. Those include $150 round-trip tickets to Hawaii from many cities in the US, or $600 life-flight tickets in business class from the US to Asia, or $100 business class life-flight tickets from Africa round-trip all the way to Asia. In case you didn't know, about half the world is open for business again and accepts travelers. Most of those countries are in South America, Africa, and Eastern Europe. To try out Mighty Travels Premium, go to mightytravels.com/MTP, or if that's too many letters for you, simply go to MTP, the number 4, and the letter U.com to sign up for your 30-day free trial. From what I read, you were instrumental in starting one of the first gold, if not the first gold ETF, also known as GLD, probably the biggest by now. How did that happen?
I was working as a consultant with the World Gold Council, and I had already been the first ETF portfolio manager in the U.S. with Deutsche Bank with the country baskets, and I had just gotten off a 4-year consultancy with Barclays Global Investors, now part of BlackRock, to do the iShares. So when I was working with the World Gold Council, I was doing some asset allocation. We had a paper that was published in the Journal of Investing on defensive assets and comparing gold and where it belongs in the defensive asset class. And then I had suggested, actually, there were different institutional uses. Why don't we do a depository receipt on gold? And then I introduced Richard Scott Ram and Rob Weinberg to the World Gold Council, to Joseph Keenan at the Bank of New York, to do basically depository receipts on gold. Now, one thing a lot of people don't understand, the fund structure or the structure of GLD is different than an ETF. They actually call it an ETP, exchange traded product, because it's like an ADR. It's a depository receipt on the underlying gold. The reason this is important is that the capital gains is taxed like a collectible, 29%, not normal capital gains tax treatment. So, and a lot of advisors buy for, this is a peccadillo of mine. A lot of advisors will buy for clients without realizing that it's not a fund, that it doesn't have the tax advantages of most ETFs. And I really think that if you're taking an advisor fee and you're buying something for someone, you should read the fact sheet and the summary prospectus.
Yeah, that's a whole other topic about reading the information that's actually behind these more structured investment products. If we step back for just a second, in people's minds, and to an extent also in my mind, I've been doing more research and tried to gain more knowledge in the industry. For most people, ETFs are basically low-fee mutual funds. So instead of having an active manager who does a rebalancing or does changes on a daily basis, depending on that particular research that the fund does, in ETF, in most people's minds, is there's an algorithm, and the computer makes all these decisions, and the algorithm is basically laid bare when you sign up to an ETF. You can actually see what this ETF will invest in, basically for the lifetime of the ETF. Is that correct?
It actually goes deeper than that.
Okay.
Let's start with the fact that aside from special products like GLD or USO, which is a commodity trading pool, and some of the exchange traded notes, most of the products we're talking about are actual 1940 Act funds, like any mutual fund, with an exception or an exemption, that instead of the shares being redeemed at the distributor on every night by any holder, the shares by small holders generally trade on the exchange, and it is only through a mechanism, creations and redemptions, that you can create or redeem new shares with the distributor, and you only do that by putting mini portfolios in or getting mini portfolios out of the fund. It's called an in-kind exchange, and it's a free receipt and delivery, and that's why ETFs have far less tax implications. And that's a structural issue. This is true whether or not the fund is just a simple cap-weighted index fund, whether it's an algorithm or robo doing an algorithm and fully disclosing it, they're all transparent, or an actively managed equity fund. With the newest wrinkle being now you can have actively managed mutual funds with semi-transparent structures like the Blue Tractor, where you only have to display part of your holdings, a segment, and give full statistics, and then you can have different trading baskets every day, so you can use the ETF mechanism, free receipts and deliveries, without actually exposing all of your positions. This is something that's just was given by the SEC rule last year in 2020, and a lot of funds are starting to take advantage of it. Let me put it another way to you, though, Torsten. Basically, I wrote about this back in 2002, and it's finally now hitting the market.
Why is it advantageous, though? Because you don't want to expose what you're invested in to the general public, only to the ones who are investing in the ETF. And how do you make that decision, right? If it's hidden from the public, isn't it a mutual fund then?
They are mutual funds. The ETFs are 40 Act mutual funds.
Right, mutual funds, but with very low fees. Let's put it this way.
Not necessarily. Not all of them have very low fees. It depends which one. A couple of them have pretty high fees, over 100 basis points. It depends what it is. This is what I'm trying to explain. Yeah. The mutual fund, whether it's an index. Let's put it another way. Index funds generally have low fees now, whether it's a mutual fund, say on Vanguard or Fidelity, Spartan or Schwab, whether or not the index fund is an ETF or a fund that you put in a 401k, it's still a low fee fund, and it's analogous. And since those funds, cap-weighted mutual funds, cap-weighted index funds, don't tend to have a lot of trades anyway, there's a slight capital gains advantage in the ETF, but it's not so dramatic. The ETF is simply a more efficient modern structure of the old mutual fund in many, many ways, and that's why now you're seeing more active managers turn to the ETF. And it's certainly better for the investor in all ways. Not only do you have the tax advantages, and not only are you able to fix your risk and know what you are paying price at a specific time, which you can't do with forward trading at NAV in a mutual fund, but it also eliminates the need for cash and cash drag. But most importantly, unlike the traditional structure, the ETF manager does not have to manage the daily cash flows. These transactions are not done in cash. None of the transactions are done in cash, so they don't have to worry about whether 30,000 more sold or bought on a given day. Unless there's a creation or redemption, it doesn't affect them. And if there is, they still don't have to do anything because it's in the size of the fund. So in that way, it actually helps an active manager more, because he or she can manage only to their own investment decision and not have to worry about what liquidating capital gains. Oh, that's my oldest idea. I don't like it that much anymore, but it's got such a high capital gain, I can't get rid of that one. Let me get rid of a fresher idea. And, that kind of conflict doesn't happen now with an ETF. It's simply a more efficient, it's a modern structure. The old structure through the distributor is really an archaic structure. There are a few reasons, like 401k, that they're still in existence, but really it benefits the shareholder in every way for it to be there, and it only doesn't benefit the fund company in perceived old ways. And like a lot of things in the investment world, we always say fear and greed are the greatest motivators. Actually, the greatest motivator is resistance to change.
And taxes, probably.
Uh, yeah,
Does this
I think ETFs and the way that you invest a little more passive, so you're not looking for a mutual fund, and we've seen a lot of statistics that the passive investing is as profitable over the long term, probably more because the fees are often lower, not necessarily. That's something I learned that ETFs, I associated them necessarily with lower fees, but I've just learned it isn't. One thing that a lot of people but including me, don't really understand with the ETFs especially is there seems to be a particular emphasis to trade on their close, right? And you just said there isn't a lot of trade, there's less trading, there's an in-kind redemption. But it seems there is the myth, maybe it's a myth out there that ETFs, especially because a lot of their trading happens at the close of the trading day, they seem to zoom out and change pretty intensively the close auction that often now differs quite a bit from how the stock traded during the whole day.
That's absolutely the case. And furthermore, there's that 15-minute period after the general close of the market where professionals can trade and true up their ETFs, and a lot of the ETF trading happens then.
Do you think it has a major impact? So there's probably like hedge funds who trade against this, that basically develop an algorithm, see what the ETFs have to do, and basically front run them. Or is that not possible with the closed auction?
No, it's front running isn't what I would call it, but they have strategies where they think that at the totally designed on that 15-minute aftermarket to try to do certain things. Yeah. Sometimes I would call them arbitrage strategies rather than automatic arbitrage, because it's not a free lunch. Sometimes they're right and sometimes they're wrong.
Yeah, as long as it's 51%, you're good to go. I mean, front running, I define it as slightly bigger. It's not necessarily the whole flash trading thing, where people actually know what transactions are going on. Like, that seems to be a big topic. I don't know if you looked into this. We can shed some light on this. There was a big debate, and when Robinhood seemed to be close to bankruptcy because of the new requirements in order to put in securities and deposits for the higher for the stocks that were very volatile. A lot of the plumbing of the actual brokerage come to light, and a lot of people assume that Citadel, the one who buys the trading information from Robinhood, they seem to make a lot of money. Although Robinhood doesn't charge you for any orders, they basically tell Citadel there's someone who wants to buy something. And it seems like Citadel makes a good amount of money from this. Do you think this is a myth too, or that's actually happening and Citadel makes a couple $2 billion from this?
I don't claim to have specific expertise in this area. The Robinhoods and the other ones that have acorns and the smaller ones that are proliferating out there in the last 6 to 18 months, 24 months, have obviously a strong following, have people of their own, and have their way of doing things. But I haven't begun to go into their plumbing or their business models. One thing about me and all of my writings and my particular bent is I am not a trader. I am an investor. I write, I create products, I put things in minds of what's good investment, not necessarily what you're going to make in the next 20 minutes and close out your book. I'm not against hedge fund tradings. I'm just saying that's not my particular area of expertise. My area of expertise is, and I have many of them, ETFs, ESG, alternative data, and things that are used. But again, like alternative data, there are some that are fleeting and can only be used for trading purposes, and there are some web scraping data that have latency of up to 45 or 90 days. I tend to stick to the latter more than the former on the work and research that I do. Not that there's anything wrong with like Ravenpack data helping hedge funds trade.
Yeah. It seems like there's a lot of niche out there. I've been looking at, and I find it really interesting that you say that, into the alternative data universe. And there seems to be a lot of interest from hedge funds primarily, but I think this also goes down to individuals, where you basically identify a data set that can be from anywhere, right? That can be, the insurance premiums for in different states for drivers on average with a certain age. A kind of random data, and there's a lot more data. There's mobility data now. There's all these sensors, And it seems there is a burgeoning market for combining this data, maybe reducing the noise a little bit, and then finding a way to trade on those. As you say, the lag time is quite long, can be a couple of months, but it is something that potentially in backtests, people usually run these backtests, that makes money, then people run these strategies forward. Do you feel, and I think this has been going on for a long time, but now there's new data proliferating. There seems to be a new boom to that industry. Do you think it is the new oil?
I'm a big fan of alternative data. Let's go back to indexing and the basic arguments for and against indexing. If you believe that you as a professional investment manager knows what value is and is smarter than the market, and that most of the people in the market are stupid, and because I'm an investment professional, I can do better, which none of the stats bear out. But if you believe that, then the market is not efficient. If you believe the results, if you believe SPIVA, if you believe all the rest, that what that cap weighted market index represents is professional flows, is dollar weighted average opinion of what a stock is, each stock of the market is worth at any given point in time. So in order to actually have a better idea of what that stock's really worth, you have to be smarter than that huge and usually mobile and expert dollar weighted cap flows that are out there. And guess what? Most actors using these old value metrics that are already in the market, already known in income statements, balance sheet, things like that, are they're left behind because that data isn't giving them anything or any advantage over there. Enter alternative data. How do you get an advantage? You have to look at something that normal investors are not looking at, that is not already in the multiple, that is not already factored into the price, that is not already a known quantity to most investors. And that's why you take a look at credit card receipt data and see what's doing there. You look at data that says what CEOs are doing and which ones have been absent or present. You look at ESG data, which is really a proxy for management quality in many ways. And what ESG data helps you do without argument in the broad sense, at best helps you by eliminating the bottom 25 to 50% of companies in each industry, the ones who have the more regressive policies, who have not been proactive to help to comply with rules and environmental change, who have not been proactive in new workforce technologies and employing their human capital assets and having two-way flows of conversation and diversity and inclusion. All of those things are risk factors if you're backwards and reactive. And the same with governance. Those who still have poison pills, those who have are violating the rules each year by violation tracker, things like that. Those kinds of things. So yeah, alternative data is in that way. I actually have three clients who are in that alternative space. One is Brand Loyalties, that looks at luminosity and does an excellent job of predicting which companies are gaining or losing share within their industry using what the brightness of certain signals on the web, which I could go into further. The DTCC, one of my main clients, you know how there were these 13F strategies and things. They now won't provide it on individual companies on the fly, but they will give you the last 3-day average of the group of different kinds of investors, like hedge funds, institutional banks, RIAs and retail, and they'll tell you who's doing what trades. You can do the same kind of strategies if you're looking for expert or not waiting for 30 days or 45 days after the 13Fs come in, but on the fly. That's alternative data that wasn't available before that hedge funds are using.
There seems to be an endless amount, right? So I just saw it when the short squeezes were on, there were obviously a lot of data about which companies who have the highest short interest. And then there was a lot of sentiment that you could lay against this. And not just you find companies with high short interest, also that actually get a lot of buzz, so to speak, on Twitter and on Reddit. So that's very far reaching and probably not very exact, but there seems to be an endless universe of this alternative data. The problem seems to be, how do you backtest it, and how do you then make a judgment call?
Yeah,
How these
signal
things
from
will look in
noise.
the future, right?
And some of it has longevity, like the brand loyalty's luminosity signal I was talking to you about. They actually have data on that going back to the beginning of Amazon Web Services 2008. So
that's amazing, yeah.
Yeah, but some of the others, you don't have as much back data on the DTCC data, which is aggregates that are done in real time. Even though the data didn't exist, they can they have the components of that, so they have it recast back to 2012.
Yeah,
it depends on whether or not it's possible to recast a data set, and back testing, and then you can have your thesis and say, okay, it worked in this time period. Now, Thorsten, I've been a quant for 40 years. I can tell you definitively what a quant does best is predict the past with ever greater precision.
I know, but that's not what we are interested in. We're interested in the future.
Yeah.
I've been running into the same problem. I've been helping out a couple of clients with their back tests, and the accuracy seems to be improving because the AI models that we work with and I work with, they're really good at curve fitting. So they're really good at finding trends in the past.
Exactly.
But that doesn't mean, but as closer they get to the curve, as more fragile they become, and when you extrapolate them and when you run actual trades on it, they have trouble figuring out are they within a certain trend. So the prediction quality has really dropped off, I feel, because the AI gives you, the way we look at these AIs and validate these models, they give you the illusion that they actually found a trend. No, they don't really know, right? They can't tell you it's a black box system. And there's this big example of Renaissance, right? Renaissance
Yes.
has been a hedge fund, has been very successful, and they've been using signal recognition and have been supposedly using technology that comes from audio signal recognition. And they've been doing very well. They probably never had a down year, and they usually made 40 to 50% a year. This year in 2020 was terrible for them because all these signals, they work in a certain market, but 2020 was just not that kind of market. And that's pretty rare. That hasn't happened in at least a decade.
But those new black swan markets, or whatever you'd like to call them, happen all the time. The market has an infinite number of permutations it can take, and I won't say an infinite number of dynamics that affect it, but certainly more dynamics than I or any AI system and certainly any human being can account for. There are just so many things that change, as time changes going forward. There's a whole new spectrum of things that haven't happened before, that haven't come before, that become a factor, that are no longer a factor, that start trading in groups, that start not trading in groups, that the information goes this way, the information goes that way. That's important now. That's no longer important. These companies no longer do this. It's no longer a factor. Those are the things. This is the classic problem value investors have, because if you're looking at book to price, over the last 17 years, 2/3 of the market cap of the S&P doesn't have any book value to go to. The book value, it's the asset that's being valued are things like human capital, patents, brand value, reputation, all things that social goodness, corporate citizenship, all things that the hardcore quants. Oh, that's fuzzy. That's nonsense. They're intangible. They'll never come back. That's what these companies are structured on. Capacity utilization of factories has nothing to do with today's company. Inventory turnover has nothing to do with today's companies.
Yeah. I mean, the value investors, and I counted myself as one. They just never get a buying opportunity. They've been staying in cash for like decades now because there's just nothing to buy that's cheap enough.
Because they're using the same accounting statements, balance sheet, what do you call it? Balance sheet, income statement, and statement of changes in financial positions that were perfectly good 150 years ago or 100 years ago in an industry-based economy, and they're being applied to something that's not an industry-based economy, and they don't account for the top assets of a company.
Yeah, exactly. So I think this is where we see Warren Buffett change his strategy quite some time ago. And he had to, right? Because there were very few companies that had certain potential to fit into the screening that he basically had invented before. So it doesn't really, he has a new screening. Obviously, he's changed his way of investment, how he finds investment targets, and it seems to work out for him. But it's quite a transition. When you think of these fallen angels, so to speak, which used to be the mainstay of value investment, we have companies like GameStop, right? That seem to be a good value investment, so to speak. They seem to be relatively cheap, and they seem to have maybe a story to recover from the looming death. Maybe not, but at least probably it was worth a shot. But the actual thesis that people bought into was completely different, right? It was a short squeeze. It was something that was screaming market manipulation, and not by an individual hedge fund, but like a group of people. But
What's the word I'm looking for? There are good things and bad things about the way these things are coming out, and people are looking at the equity markets and things like that. It reminds me somewhat of the fad in the late 90s to do the when you bought somebody's day trading, the day trading fad in the late 90s, where people started looking at the market as a casino and something they could win big at with the right tip or whatever, then looking at it as what most people, especially people who aren't with the highest capitalized hedge funds in the world, what most people should be looking at it, which is an investment mechanism and a mechanism to save for the various things you want in your retirement. And everyone's in on these things, but there are prudent things you should be doing. And unless you really have a reason to believe you have better information than the market on a certain stock, a certain company, or what's going on here, you're swimming with the sharks, and you might catch a couple of nice things, but you're going to get eaten eventually if you keep doing that. It's like trying to make money at a casino long term. You might make a great, you might go in there and you might make 60,000, 100,000, maybe even $1 million in one night. But if you keep playing, you're going to lose.
Yeah, that definitely seems to be the problem with this. You got to go big and quick, and as longer you play, as more you can be in trouble. I think a lot of people have figured that out too. But it's quite amazing that these short squeezes come back. I mean, they've been around for a long time, but it's the vigor and the way they've been analyzed. So I read a lot of these Reddit posts. These people know what they're doing. At least the initial instigators, so to speak. They have done a careful analysis. Obviously, they don't know what will happen, and if enough other people join to that cause. And I found it really interesting that the initial post on Reddit, who actually talked about GameStop and the potential short squeeze, it recommended at the time to buy the longest dated options, it was 3 months out. And the initial short squeeze when GameStop first started to explode so much, that was exactly 10 days after that option expired. So how unpleasant is this? If you believe in it, if you buy the 3-month option, it goes worthless. And maybe you didn't buy another one because you think the stock is never going to move. And then suddenly after that, it starts moving, which is, I find that really strange, a really strange time. It should have moved probably within that initial time frame, but it didn't move at all.
Well, you're trying to herd cats and make them do things. And sometimes you can herd cats, but it's really hard to herd cats on a timetable.
Yeah, I call that impossible. I call it impossible. Not just not possible. One thing that's closer to the ETFs, and maybe it's foolish for me to think, but isn't there a way that instead of doing ETFs, which to an extent, right, were introduced because it was hard to rebalance your own portfolio. Now that it's free, it does have a tax effect, but it's basically free, so to speak, with these zero commission brokers. Why don't people just basically do their own ETF at home, right? It's basically just a computer algo that says, I want 10% of whatever is in the S&P, or I want it exactly structured like the S&P. Is it really just a tax reason that ETFs still exist that do exactly that?
Well, there is tax efficiency, but again, it's not only which stocks you want, but in what proportion and how do you save it. One of the the original market that Bill Sharp envisioned, he never envisioned a cap-weighted portfolio. He just thought it was all the stocks and it was a theoretical. The first people who did this in 1973, Bill Faust, Jim Verton, and Scotty McQuone, what they basically came up with it originally, they were trading an equal weighted portfolio and they were getting killed. In 1973, transaction costs were very expensive. They were not de minimis.
Yeah.
And then they ran across this S&P thing, which was the S&P 400 at the time, soon to be the 500, which came from an old Cowles Commission capturing these cap-weighted flows. And you know what they discovered? That if you're a portfolio manager and if you buy this today and none of the stocks leave the index and everything, you don't have to rebalance the next day. You are already holding the right proportion that's in the index. This is something that seems obvious, but really people don't understand the genius of that from a portfolio management standpoint. There's no rebalancing you have to do. And guess what? Even if you're paying $0 to your broker for a trade, especially if you're 500 stocks or more, you're paying something in impact cost over time as you're trading in the market. And then there's the tax implication. So yeah, there are of course now these custom indexing shops, these a number of these that are doing this, what they call direct indexing and things like that, so they can do customized for your portfolio. But yeah, they don't have tax advantages, and and it depends on the weighting. But again, one of the supposed truisms is that equal weighting will outperform cap weighting, and it always depends when and what period. I got to tell you, over the last 10 years, RSP, which is the equal weighted S&P 500, and with a 20 basis point fee from Invesco, has underperformed quite a bit the S&P 500 IVV or VOO. And by the way,
I can imagine, yeah. I can imagine, because we're in this huge trend following universe, right? So every trend is just getting bigger. So you're literally, I find this amazing that one of the biggest companies on the planet, Apple, is also the one that's growing the most. And that's just the momentum that has reached, especially the last couple of years. It's just astonishing to me. I did never see that coming. Maybe, well, obviously, not just maybe, obviously the market knows something I do not, right? The market seems to know that these companies will be even bigger, and Apple is now, I don't know, bigger than the GDP of the UK. I mean, it's incredible.
Yeah, it is interesting. And, each company has its own story, and as time goes on, they'll eventually not always move in the same way. That much I can tell you. Which one will move the wrong way first and what's going to happen, that I can't necessarily tell you. I do know that.
That's what I wanted to know from you. That's why I have you on.
If I had to pick one that 10 years from now will be as big or bigger from where it is now of the top 5 or 6, it would be Amazon, because they're constantly creating new value. They're constantly looking ahead and looking at what creates new value, and they're not stuck in a model saying, hey, we're geniuses. It's worked this way. It's always worked this way. It's always going to work this way.
Yeah, you're right. Absolutely. That's really company ethos there. But I feel like they are also the worst in terms of bureaucracy. I've never seen a company that's a tech company has so much bureaucracy and so many layers, and it's structured like IBM in the 70s. I'm like, holy smokes. It works for them so far.
Because they're trying to do and be at the forefront of so many different things. Everything from electric cars to alternative energy to, who thought Amazon Web Services would be their most profitable business over anything that they sold over the internet?
Well, I always believed in that. I was like customer number 5 or something. So I was in the early betas. Yeah. And
so were we.
That just looked so good, and it was so well done. Especially it scaled up a couple of years later. And there's literally no cost to them. So I mean, saying that this is the most profitable, they can play around with the cost, right? They put the cost into the retail arm, and then the profits stay with Amazon Web Services. It's a little unfair.
Yeah, look at their R&D expenditures as compared to Google. I mean, not Google, I meant to say Facebook. Much more, R&D expenditures, much more of that going forward, things like that. I think Facebook is eventually very vulnerable for a number of reasons, but I'm not about to short it today.
That would be a risky undertaking, but I agree with you. Facebook definitely doesn't have this technology stack, and most of their money comes from violating privacy laws, let's put it this way. So they don't have a lot that consumers really value if they are not, drugged into whatever social interaction is going on there. So I think I fully agree with you. They're very vulnerable.
And they become too much of a political football, and that's or soccer ball, if you wish, because it's global. It's not just the U.S. And
absolutely.
They have the high profile for the wrong reasons, and they're considered so dangerous to so many people. It's just there are just too many constituencies building against them. Yeah,
I have the same impression. Absolutely. But I've been wrong so many times, so it probably doesn't matter at all. Yeah. One thing, though, just going back to the ETFs, one thing, and you did this with gold, so it's something that wasn't within the reach of normal investors, at least not directly trading, and you made it possible through the mechanism of an ETF.
Well, ETF beginning. Let me backstep you to first the country index funds. They weren't available as stocks. They were just the closed-ended funds with high management fees and things. But then the iShares, the real genius there, the guy who hired our consulting team in there, a fellow named Lee Cranefuss, who worked for Patty Dunn. Lee Cranefuss called us in one day and said, we are going to be the movers, and we are going to create an ETF supermarket that brings institutional type products at cheap fees to retail for the first time. And we're going to do this to benefit the market, and we're going to be the first movers for one advantage. You know why? Because we have no existing mutual fund family to cannibalize. That's why Vanguard wasn't the first. That's why State Street wasn't the first. It was why iShares, took the lead on all the bond ETFs out there. They captured the fact that they didn't have that internal problem, and they went out there. State Street was trying to save something called its Navigator funds, which accounted for 10% of their revenue. But companies are crazy. I'll show you a personal story. I was doing there used to be a Pacific Stock Exchange. They had 4 tech indexes. We were calling them the techies. I was doing this for New York Life Investment Management. The SEC had approved it. We were going to go effective on the following Monday. That Wednesday, 4 business days before paying effective, all the wholesalers, all of them, from Mainstay, walked into the CEO's office and says that if you launch this ETF, we're leaving you and we're taking our customers with us.
And what happened?
We didn't launch the ETFs.
Okay, so much for that. I was just curious, and something similar might have happened there. The ETFs and the genius, as you say, it made so many things tradable, and the country indexes was one example. One was like regions. There's a lot of places in Africa where it's hard to trade, huge transaction costs, hard to get into the stock exchanges. If you read Jim Rogers, it was usually his biggest problem was not to buy stocks or to execute the stock transactions. Always opening an account, getting a brokerage account, incredibly difficult. And there's minimums, and you have to be registered.
And custody and all this kind of thing. Yep.
Yeah, and I always felt an ETF would be great. I mean, obviously, the ETF would walk in, say, has $1 million in each country, say in Africa, and then retail investors could take advantage of this. Do you think that's coming up? That's actually on the horizon? Because there's very few, for instance, in Africa, that might have other reasons. There's very few ETFs that are listed right now.
Well, you have a few on the Joburg JSE, and you actually have, I think, about 24 in Mauritius. Yeah, Mauritius Stock Exchange.
But they don't hold assets, or they don't track anything that's on mainland Africa, right? So that's Mauritius is usually Indian investments, because it's like the tax haven for most Indians, and obviously South Africa is there, but the rest of Africa, let's put it this way, Sub-Saharan Africa.
There are burgeoning markets there. Certainly, there are some Egyptian ETFs. I think a handful. There are. But most of them don't have enough liquid stocks to have a market out there. And on the fixed income side, of course, a lot of the Islamic markets, you can't hold debt, right? Islam, it's a sin to hold debt. It's not Sharia compliance. So those are a couple of the issues, but they're thin markets. The exchanges aren't there. It's not like India, where there are a lot of Indian ETFs, but unless you're in India, it doesn't, there's no reasonable way to trade it without paying a lot more for the transaction than the fund is worth.
Do you think there is a shot for and I think we have that in the US, but do you think there is a product that or a marketplace where you can trade irrespective of borders, kind of like a Bitcoin universe for equities. Do you think that someone is working on this, or someone has had that idea before? It seems to be you always pay way more if you go into a country as a foreigner because you can't go to the best possible instrument.
You know, this is a very interesting point in many ways to me. And yeah, there are things that you can do, but there's so much politics. You would almost, this is where cyber currency or baskets of cyber currency may eventually play a role. Because right now, if you have to clear through the currencies and everything, that's the problem with even emerging markets ETFs. There are so many currencies and clearing and fluctuation, and those are the efficient ones. And what you're talking about are frontier markets, and that's where, there are a couple frontier markets ETFs, but they're not very liquid. And these are the reasons there. But I was involved back in 2002 for 3 years in something that we called EuroClear. We wanted to have European clearing on the euro and be able to clear all the countries by euro, one clearing system for all of Europe. We thought we would have it done. We started in 2002. We thought we'd have it done by 2003, 4, 5, 6. It's 2021. It still doesn't exist. We gave up.
Okay. Yeah, Europe is probably much easier than say a good part of Africa.
But getting all the little idiosyncrasies and all the, and greasing all the hands that wanted to be greased for regulatory approval was too much for us.
I can imagine. Do you think there is a crypto future for equity? Can you kind of, there's all these synthetic funds, so you basically
just have like local Bitcoin. There's absolutely no reason equities can't be denominated in crypto. And in fact, I think there are some nascent ones that are. I will defer to my favorite cryptocurrency expert, Matt Hogan, over at Bitwise. He's done very thorough research on that and would highly recommend him as somebody to speak to if you're looking for a crypto program. He's great. Matt Hogan over at Bitwise.
I will do that. Yeah, I will do that. Absolutely.
But from a conceptual standpoint, yes, there's no reason that burgeoning companies, especially ones that don't want to be gamed, can't or wouldn't issue stock denominated in Bitcoin on a cyber exchange.
Yeah, people called this an ICO, right? And the ICOs have gotten a really bad rap. They were
the initial
not necessarily companies you wanted to invest in. But that seemed to be the precursor to this, right? But there was no regulation.
I guess you don't remember when the tech bubble was burst by the mezzanine financiers and Goldman Sachs and Morgan Stanley proclaimed e-commerce is dead. People are always going to want to come into a brick and mortar store.
Well, they hopefully didn't put too much money into that belief.
What they.
Goldman Sachs is more clever than this.
Do you know Goldman Sachs didn't even have a website till 2003? They thought the internet was for clowns, checks, and retail.
Yeah, well, they're not good at predicting long-term trends. Let's put it this way. They're really good to it. I don't know what it is, but steering customers who seem to be slightly less clever than them and steering them into a product, they make a lot of money. And then the clients usually still make some money, but way less than they do. And they seem to do this in a way that's kind of magical. Or I don't actually know who are the clients of Goldman Sachs, but maybe we just need to educate them. It's like all these German banks, right, that bought these structured mortgage products, and that was fascinating to me. Why would you ever buy those, right? I mean, there is things that appeal to a lot of German fund managers, but still, that seemed ridiculous. But they bought it by the billions.
And with the exchange now allowing the direct listing and everything, that the value of an investment banker is getting less and less and less, and which is a good thing because investment. I'm I'm an ESG advocate, an advocate for transparency, an advocate for fair, open, and transparent. And Goldman has always been the opposite of that. Investment banking has always been the opposite of that. We fire people who don't give positive recommendations on our investment banking out there. Now 20 years later, the lie has been put to, for the most part, to sell-side analyst recommendations. The lie has been put to the trading model that you have to trade through these guys, that it's giving you some kind of advantage. The lie has been put to all these things that they made money as an intermediary. The last cash cow was investment banking, and the lie is being put to that too. So if you tell me that on a current PE or PB or price sale, well, there's no sale, or price cash flow basis that Goldman is cheap, I said, yeah, but I'll bet you'll get cheaper because their business model doesn't have a future.
Yeah, I would agree, but I thought that a long time ago, and they're still holding up pretty well. And Warren Buffett is out now too, but I don't know if this is a good or bad sign. But I see the mega trend, but I thought it would have happened already. Maybe I'm just too impatient.
Yeah, that's the thing about quants. They tend to be very smart and very early and very impatient. That's our what's the word I'm looking for? That's just a
stupidity.
Yeah.
So one more thing I wanted to pick your brain at, and I don't know if you've seen this. So Mike Green is a fund manager who used to work for Peter Thiel, and he's been coming up with this theory that, and maybe it's not his originally, but it's something he propagates. And he's saying, there's all these ETFs now, and that most of the transactions or most of the investment is basically done by passive investors, right? So passive investors is basically, I have money this month or right now, please spend it on something, like my mix of ETFs or one particular ETF. So it's basically a one-way
put the obvious case in there, the 401k or the 403b over here. You've got your option. Here's my index fund. You dump it into the index fund, or you put it in a, what do they call that, lifestyle fund, and that lifestyle fund puts it in the index for you, or you put it into Betterment and they put it into the index for you. But you're
right, so it's BlackRock or Vanguard or something. There was
dollar cost averaging. Your dollar cost averaging, and every time you put it, it goes into the index, and that's not going to make the index more top heavy. By the way, it's going to keep the same proportions if you're the only investor. If the only investors are more index investors.
Right. What I was trying to get to is basic argument is, well, we have this massive amount of passive investing, and it's basically 99% of the market. We just don't see it. So there's very few active investors who basically do the arbitrage game of buying low and selling high. So that's why we have this high volatility. Again, it's a theory. We see higher volatility because we either have passive investors just dumping money, irrespective of prices and valuations, or we have passive investors saying, no, I need the money this month, so I'm not investing. And that's basically this depression cycle that seems to drop the markets pretty quickly. Like we saw it as a March, the market dropped within a few days, dropped like, 40%?
Analyses of the flows doesn't hold out with that at all. First of all, the overall in market cap weighted index funds with U.S. assets, the overall percentage is at an all-time high, but that's 34%. So it's still 66% is non-indexed. And that's retail, institutional, all of that put together. And that was from PwC. They just had a study on that with S&P. So you still have 66. Now, of the 66, a lot of it is tracking the index. It's active money that's tracking the indexes, and they can't get too far away. So they're, you can call them closet index funds if you like. I think that's in one of those overdone terms like greenwashing, which at the end of the day probably hurts people who believe it more than it helps them. But you could call it a closet index, whatever, and others have to go there. But it's there's still 66% of the money, and there's still enough money there that is, calibrated on the demand for that stock. Why the demand is there for that is it, it's not all. One thing is for sure, stocks aren't valued the way they used to be, and I just gave you the reasons why they aren't. So it's not on, projecting what the past earnings were, pushing those earnings or revenues or book value forward and saying, okay, this is the right stream for it, because those numbers are all wrong and don't have to do with the value of the company. But what they do want to know is what they are being put or bet or flows according to where they think the most attractive place to put these flows and monies of. But if you want to know my opinion of the number one factor that's kept the market so resilient and has as high as it is, and I'm not the first one you heard that from, but I certainly think it is. At the end of the day, what is the stock price on? What is if you have auction pricing, at the end of the day, what is the stock priced on?
Well, it's certainly a future expectation, right? So you either expect it to rise or drop.
Basic. Supply and demand. And demand. So what? Okay, so here's the demand. Here's all these dollars, and it's going into the stock. Where else could the money go? Well, invest. What do you call it? Companies could use it to invest in land. They could use it to invest in equipment. They could use it to invest in people. They'd rather buy back stock. Individuals who could use it to put in fixed income and get 0.5% for 10 years. There's nowhere else to put the money that they think they're going to get a better return than in their own stock or in the existing big stock. And to bet against the companies that are doing the best, again, you should know something more than the market does. And unless you do, you should probably just go with the herd.
Yes, true. And well, the herd can go the wrong way. That's always the trouble, right? That's I think what a lot of investors are currently
but
worried
how many
about.
people have gotten fired or gone broke waiting for the herd to go the wrong way? Timing is everything.
That's another story. Yeah, absolutely.
And now we're back to what I started with, Torsten, the hubris factor. I'm an investment professional. I'm smarter. I'm going to be a contrarian. Let those rhinoceri, let those lemmings follow the crowd into the sea. I'm going to be the smart one. I'm going to be there. Yeah, but we're closing out your book today. How smart were you? Not too smart? Well, see you later. You don't have our money anymore.
Yeah, it doesn't work so well with these short squeezes, right? You're very vulnerable there. Do you think we a lot of macroeconomists describe this as a low productivity environment, and the low productivity environment just makes it very hard to find opportunities, and we see this with the super low interest rates. Very few areas where you actually find decent growth. That seems to be, according to what investors tell us, because the prices have risen so much, seems to be tech. If you get to predict this, do you feel we're going to be stuck in this low environment, productivity and growth environment for quite some time, or this is about to change?
It's an excellent question. Not one I have some thoughts, but no sagacious answer or any answer that would say, well, don't do what you're doing now. I'm not and I'm also not somebody who will ever predict 0 or 1. Oh, I'm going to be 100% out of the market or 100% short the market, or I'm going to be 100% in the market. I don't believe in that, because I don't believe any of my quant models, and I have a lot of them, or any of my theories or any of my experience will be 100% accurate in the future or 50% accurate in the future.
51%. That's what we want, right?
Yeah. I mean, it's really tough. Number one, I want to know what I told you. Will there be somewhere better to put the money than the U.S. equity market? Right now, the only other place people are making money and can do it and like to do is emerging markets. Emerging markets debt is very popular, and emerging markets equities. And yeah, you can do that. Is the risk higher? Yeah. Some people, like myself, put the traditional 5% allocation to gold in case things go haywire in the equity, because the one thing about gold, it may be correlated sometimes, not correlated sometimes. If equities totally go to shit, gold will do fine.
Yeah.
Well, and some people now see the target currency as another safe haven asset. I'm not convinced of that. I'm not saying it definitely isn't, but I don't have enough evidence to trust it to be that kind of an asset to me. So there are lots of things, in terms of diversification and what will go there, but we'll go to a new normal when there is either inflation enough to raise rates, If we have 100% employment, is one of the things that Maxine Waters and Elizabeth Warren want the nation to pass through with their 50+% majority. If we have that kind of thing, we would have inflation. If we have inflation, we'll have higher interest rates. If we have higher interest rates, we're going to some of the money will leave the equity market.
Yeah, but I think the question is, given how much money we print and how it seems that we add inflationary pressure for a long time now. You've seen asset prices rise quite a bit. We've seen that not just in equities, but we've seen that in lots of different assets. Strangely enough, the consumer price index and lots of things that consumers buy, they haven't risen much, which I think is great, right? It's a great achievement. But it seems the inflation that we track seems to be stuck in a certain area, irrespective of what we do, how much money we print. Even when we had really good employment numbers before COVID, it wasn't much affected. Have you ever thought, but what's really going on?
What there hasn't been is a bidding war on salaries. The median salary hasn't gone up, and that is the key indicator in inflation, along with key commodity prices that you need. And if anything, reliance of those commodities has gone down. Those are the big two factors that will actually move inflation. This money supply, Milton Friedman argument, I think, has been proven wrong more times than it has been proven right. Again, we're like dogs with bones. We can't get rid of those theories. I'm an empiricist. The last 5 times I've seen that trial, it hasn't worked. M3 is bullshit as far as, actually causing.
Well, there seems to be this marriage, right, of emerging markets, especially China and technology, that has been a bigger impact than before. Maybe just because we look at the world now and it affects the US different. I'm really curious to find that one answer. Maybe there is no such one answer, but why we had all this seemingly strong inflationary impacts, but they didn't really change the CPI itself. And I was listening to David Rosenberg, and he's like, one of the biggest inputs is literally rent and is the prices you pay for fuel. If they're relatively stable, the CPI won't move, irrespective of what the food prices do, for instance.
Exactly, and that's exactly what's been happening.
I really thank you for doing this. I know it was kind of a bit last minute, but we covered so many things I really wanted to talk about. I really appreciate it.
Take care.
Take care. Bye-bye.